Hey, and welcome back to another episode of the Friday Five. Last night, the Yankees knocked the Red Sox out of the playoffs, so it's a great day today. And hey, even the Giants got a win this past week, and Jackson Dart is 1-0. So, big New York fan. It's been a good week for New York sports. And let's chat about mortgages a little bit. Let's start where we always start, with mortgage rates. Again, these are national averages from Mortgage News Daily. VA 30-year fixed 6.05%, FHA 30-year fixed 6.03%, conventional 30-year fixed 6.34%, conventional 15-year fixed 5.84%, and then conventional 7-year ARM 5.76%. So rates are still a little bit higher than the best levels that we had seen in mid-September. Some of that is just a pullback after the Fed 0.25% rate cut due to some comments from Powell, some of the economic reports that have come out. I think there's still some optimism that rates may improve, but gosh, nobody has a crystal ball, and even the best economists' forecasts are wrong consistently. So we'll see what happens. Number two, some big news this week in housing, real estate. There's a big shakeup. The FTC sued Zillow and Redfin. According to the FTC, Zillow paid Redfin $100 million to step back from competing in the rental listing market. So the feds say that the deal that Redfin and Zillow put together kills competition. It hurts landlords. It hurts renters, and also violates antitrust laws. So the FTC and state attorneys generals want the deal undone. Zillow and Redfin, of course, say they did nothing wrong, but we'll see what happens. This could change the rental market in a pretty big way, depending on the outcome. Number three, medical collections. Nobody cares. Well, just kidding. It's not that nobody cares, but for most mortgage products, FHA, VA, USDA, and conventional, medical collections are treated more favorably than other types of collections. You're usually not required to pay them off, and the lenders don't usually have to include a monthly payment in your debt-to-income ratio. The big thing to keep in mind, though, is that medical collections are going to affect your credit score. So if they're on your credit report, they're still a collection, they're still going to pull down your score, which still could drive your approval or your interest rate. So certainly when you incur medical bills, I think you should pay them. Certainly not advocating for not paying them, but the bottom line is medical collections by themselves usually aren't going to stop you from getting a mortgage or getting approved, but they could negatively impact your credit score or your interest rate. So if you've been holding back on buying because of a medical collection, it may not be as big of a roadblock as you might have thought. Number four, here's something buyers don't always factor in the whole home buying process. Homeowners insurance. Annual homeowners insurance premiums across the country have jumped quite a bit, sometimes hundreds or even thousands of dollars more per year. The thousands of dollars is in some of those hurricane or flooding areas where you could have significant damage due to hurricanes or flooding. So buyers, what should you be concerned about? Well, you should work with your real estate agent and your lender to connect with a local insurance agent up front once you're under agreement on a property to get a solid quote for homeowners insurance so you aren't surprised later in the process at how much it costs. Lenders are always going to estimate the expense of homeowners insurance for you, or a good lender will, and include it in your closing cost worksheets and your payment. But there could be big fluctuations in cost for homeowners insurance depending on the age of the home, your deductible, your coverages. So you want to try to get a solid quote for that pretty much up front once you go under contract. Number five, the thought of the week. And this stems from me being a big football junkie and a Giants fan, and then also kind of coincides with my role here running a mortgage branch and trying to recruit. So if you are anywhere in life, I think you want to do your best to find optimal conditions. And here's a great example from a sports perspective. Saquon Barkley, as a New York Giant, as much as it pains me to say, was not playing under optimal conditions. He had a marginal offensive line, a marginal quarterback, and probably not great coaching for quite a few of his years. Contract dispute, he moves over to the Eagles and he flourishes. He was always a great player, but he went from being a great player to being an elite player. And he became an elite player, not necessarily because I think his skills improved, but the conditions around him became optimal. The offensive line was amazing. The play calling was great. The quarterback play, I think, is still marginal. Some of you will argue with me about that, but I don't think Jalen Hurts is elite. But everything for a running back there in Philadelphia was much more optimal for Saquon than it was in New York, as much as it pains me. And I think this can be the same in business. Instead of being content in a comfortable situation, I think sometimes if you want to be elite, you need to look for the optimal situation where you can display your skills at the absolute highest level. Thanks for watching, friends. If I can help you in any way, please reach out. And if you think these videos are helpful, then pass them on. I really do this to try to educate and bring value. And maybe if more people see it, then more people will benefit. So thanks for watching. Have a great weekend.